Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Microsoft.
If you find our talks useful, please consider subscribe, like, and comment underneath.
So today we are wrestling with a giant.
A giant that just released a set of financials that are, frankly, confusing the heck out of Wall Street.
Confusing is a polite way to put it. I'd call it a full-blown paradox.
It really feels that way. I'm looking at the Q2 earnings for fiscal 26. That's for the quarter that ended December 31st, 2025. And on one hand, they absolutely crushed it.
They did.
Revenue, earnings, growth, everything is pointing up. And yet, the stock fell 6% the next day. So the mission for this deep dive is, well, are we looking at a disaster in disguise, or is the market just having a panic attack?
It's that classic disconnect, isn't it,
Yeah.
between the headline numbers and the investment narrative.
And the headlines were incredible.
Spectacular. But the narrative, the story investors are telling themselves, it got completely hijacked by one very specific, very large number.
We'll get to that scary number, and it is a monster. But let's set the stage with the good stuff first. I mean, just to orient everyone, we're talking about a company that brought in $81.3 billion in revenue,
In just 3 months.
up 17% year over year.
Which is just wild at that scale.
Exactly. For a startup, fine. For a company the size of Microsoft, that's like defying gravity. Usually the law of large numbers grabs your ankles and slows you way down.
Right. And then you look at earnings per share. $4.14, up 24%.
If you owned a local business and your profits jumped 24%, you'd be popping champagne. But on Wall Street, they posted these numbers, and traders just smashed the sell button. Okay, let's rip the Band-Aid off. Why? What was the one thing that spooked them so badly?
It was the credit card bill.
That's a good way to put it.
Capital expenditure. CapEx.
The cost of doing business. Or in this case, the cost of, building the Death Star.
Or building the future, depending on your perspective. But yeah, the sticker shock was very real. In a single quarter, Microsoft spent $37.5 billion on CapEx.
I just want to pause on that for a second. $37 billion, a number that big just washes over you. But that's more than the entire market cap of a company like Ford.
They spent that in 90 days.
It's staggering.
And it's up 66% from the same time last year. And get this, about 2/3 of that is just going into hardware. GPUs, CPUs, servers. They're basically buying chips as fast as they can be made.
It sounds less like a business strategy and more like a frantic arms race. And I think that's where the fear comes from, right? Investors see this cash burn and they're asking, is this just a reckless gamble?
That's precisely the fear. It's the money pit theory. The worry is that they're building all this infrastructure, but the demand won't show up. Or these data centers just going to sit empty?
But, and this is why we do these deep dives, you can't just look at the expense column. You have to ask why they're spending it. And you found a number buried in the report that completely flips the script on this whole money pit idea.
I did. And honestly, it's the most important number in the entire report. It's called RPO.
Remaining performance obligation. It sounds like the most boring accounting term ever invented.
It sounds dry, but I promise you, if you're a shareholder, it's thrilling. Think of RPO as the company's backlog. It's revenue that is legally contracted, signed, sealed, delivered, but just hasn't been recognized yet.
So it's not a sales pipeline or a guess. It's legally guaranteed future money.
Exactly. It's a promise to pay. And in this quarter, Microsoft's commercial RPO surged to $625 billion.
Whoa, back up. $625 billion.
Billion.
With a B. Up 110% year over year.
That's more than $500 billion just sitting there waiting to be collected. Think about it this way. If a home builder says, I'm spending a fortune on lumber, you might worry. But if they then say, oh, it's because I've already sold every single house and the contracts are signed, suddenly that spending isn't a risk anymore.
It's just fulfillment.
It's just fulfillment. They aren't building data centers on a hope and a prayer. They're building them because customers have already signed contracts worth over $600 billion. They have to build this stuff.
That completely reframes the $37 billion in CapEx. They aren't burning cash. They're stocking the shelves because the store is already sold out.
Precisely. And this gives them incredible visibility for the next, say, 2.5 years. The demand is not hypothetical. It's contracted.
And it's not like they're going broke doing it either. I noticed they're still returning a ton of cash to shareholders.
That's the ultimate flex, right? Even with that record-breaking spending, they gave back $12.7 billion to shareholders this quarter in dividends and buybacks.
up 32%. That is wildly confident. A company that's worried about cash flow does not increase its buybacks by 30%.
It just speaks to the power of their moat. And we should talk about that moat, because this isn't just about spending power. It's about what I call the integrated AI stack.
Right. So usually in tech, you're the hardware company or the cloud company or the app company. Microsoft is trying to be. All of them.
They've vertically integrated the entire food chain.
Yeah.
At the bottom, you have the infrastructure. That's Azure. In the middle, you have the AI models through their OpenAI partnership. And at the top, you have the actual application. That's Office, Teams, GitHub, Copilot.
The distribution.
The distribution is everything. Copilot now has 15 million paid users. If you're a Fortune 500 company, you're already using Office. So when you decide you want AI, do you go hire a new vendor? Or do you just toggle the switch on the software you already have?
It's the path of least resistance, the enterprise lock-in.
Exactly. The switching costs are becoming astronomically high.
So fundamentally, the business is a fortress. We've established that. But we have to address the stock price because the market clearly disagreed with us on January 29th with that 6% drop.
It was ugly.
So walk me through the psychology. If the backlog is huge, why the sell-off?
It's what we call technical tension. The fundamentals are pulling one way, the revenue beat, the Azure growth, but the narrative is pulling the other way. And right now, that narrative is all about fear.
Fear of the spending?
Fear of the CapEx, yeah, but also macro fear.
Yeah.
The S&P 500 has been weak, interest rates are high. There's this general anxiety that the AI bubble is going to pop. So when investors see a number like $37 billion in spending, they get jittery.
It's a sell first, ask questions later reaction.
Exactly. And the stock had a great run up before earnings. So this looks a lot like profit taking mixed with that macro anxiety. But here's the thing. If you believe in that $625 billion backlog, then this drop isn't a failure.
It's a gift.
It's an accumulation zone. The stock didn't drop because the business is broken. It dropped because of sentiment. And sentiment is temporary. Cash flow is permanent.
Speaking of sentiment, the analysis scores right now are actually slightly negative.
They are, but you have to peel back why. It's almost entirely because of headlines screaming about CapEx. It's just noise.
Right. There's a big gap between what the algorithms are feeling and what the CFO, Amy Hood, is actually saying.
That's the analyst sentiment gap. She confirmed they exceeded expectations everywhere, but the bots are picking up words like spending and cost, and they're not picking up the nuance of that RPO growth.
Okay, so the market is distracted. What snaps them out of it? What are the catalysts that get people looking at the growth column again?
There are three specific bullish catalysts that I think are being overlooked. The first one is juicy. It's the Perplexity deal.
Oh, I love this story. Perplexity is that AI search engine that everyone says might kill Google, right?
That's the one, the darling of the AI world. And historically, they've been an AWS shop built on Amazon's cloud. But they just signed a $750 million 3-year deal to use Azure for their AI.
Wow, that's a massive defection. It's like the star quarterback quitting to join the rival team.
It is a huge validation. This is a tech-native company, right? These engineers know what they're doing, and they looked at both options and said, we're going with Microsoft. It validates Azure's technical superiority.
That's a bad look for Amazon if you can't keep the hottest AI startup.
It raises questions. And speaking of validation, the second catalyst is the rumor mill around OpenAI. Lots of chatter about an IPO maybe in 2026.
That would be the IPO of the century.
It would be massive. And remember, Microsoft owns a huge stake. So if OpenAI goes public at some astronomical number, it instantly validates Microsoft's entire investment strategy.
It turns that money pit narrative into a winning lottery ticket narrative.
Exactly. And the third catalyst involves Amazon again. Rumor is they're preparing to invest $50 billion into their own AI.
Wait, 50 billion? We just freaked out over 37.
Right. And if it's true, it just confirms the trend. It proves this level of spending isn't reckless. It's the new cost of entry to play at this table.
So Microsoft is already building the house while Amazon is still running to the hardware store.
That's a great way to put it.
All right, I have to play devil's advocate. We can't just drink the Kool-Aid. Let's talk bear case. I want to go back to the margins. Cloud gross margins dropped from 70% to 67%. That's real profit evaporating.
It is, and that is a valid concern. When margins compress, investors get nervous. But you have to look at why they're compressing. It's because of the depreciation from that massive build-out.
So is it sustainable?
Well, look at the operating income. It still grew 21%. So even with lower margins, they're making more total profit. Management's been clear. This is a strategic trade-off. They're taking lower margins today to capture market share for the next decade.
It's the old Amazon strategy, ironically.
It is. They'd rather have 65% margins on a pie that's growing exponentially than 70% margins on a much smaller one.
Okay, risk number 2. ROI anxiety. We hear this a lot. Is AI actually useful? Are companies really making money from this stuff?
This is where we go back to the data. Look at commercial bookings growth. It was up 230% year over year.
230%. That's not a typo.
Not a typo. That's the market voting with its wallet. You don't get that kind of growth if the product is vaporware. The demand is real.
Okay, last risk. Competition. Amazon, Google, they have deep pockets too. Can Microsoft lose its lead?
They're formidable competitors, absolutely. But Microsoft has the secret weapon we talked about.
The enterprise lock-in. Office.
Office 365 Copilot. It's already integrated into the workflow of almost every major corporation on Earth. The switching costs are just too high. Even if Google has a slightly better model, Microsoft wins on integration.
All right, we've looked at the good, the bad, and the very, very expensive. Time for the verdict. How are you scoring Microsoft right now?
I'm giving this a bullish score of 8 out of 10.
An 8. That's a high conviction score.
It is. I'm averaging a 7.5 for the near-term choppiness with an 8.5 for the long-term fundamentals.
So what's the core thesis, the elevator pitch?
The thesis is the AI infrastructure monopoly. Microsoft is the primary beneficiary of this whole enterprise AI adoption cycle.
Now the pitch.
You have a company growing revenue at 17% at massive scale. They have a $625 billion backlog of guaranteed future revenue. The market panicked over the cost to build that backlog and basically created a 6% discount on the stock. You're buying $1 of future growth for 94 cents because everyone else is worried about the electric bill.
Worried about the electric bill while sitting on a gold mine. I love that. What's the time horizon here? This doesn't sound like a quick flip.
Oh, absolutely not.
Yeah.
This is a 12 to 24-month hold. It's a play on the entire AI supercycle. The next 3 months might be noisy, but the visibility into 2027 and 2028 is crystal clear.
So patience is key.
Patience is key. And the final thing to watch, the thing to watch like a hawk, is the margin stabilization in Q3.
Why is that the signal?
Because that's the proof of concept. If they can hold margins at 65%, while Azure keeps growing at 38, 39%, the stock is going to re-rate significantly higher. It tells the market the money pit phase is over and the cash printing phase has begun.
So ignore the headlines, watch that margin percentage.
Wealth is built by looking at the data, not just the headlines.
And there you have it. The market sees a spending spree, but the data shows a monopoly in the making. A fascinating deep dive.
It's always messy before it's profitable.
That it is. Thanks for breaking it all down. And to you listening, thanks for trusting us with your time. If you enjoyed this deep dive, make sure you're following the show so you don't miss the next one. We'll see you then.